If you just turned 65 or somebody you love did this year, stay with me for the next few minutes, because there are 3 specific bills sitting quietly with the CRA, with your bank, and with your local property tax office, and every one of them is worth checking, often over $1,000 a year when you add them up. Nobody at those 3 places is going to call you and say, hey, you don't have to pay this anymore, or you're eligible for this credit. That's not how any of this works. You have to know to ask. So in the next little while, I'm going to walk you through 3 dangers. 3 places where money quietly slips away from people our age simply because nobody told them. And then 5 solutions for what to actually do with the money you free up. Stick around to the end, because the last solution is the one almost nobody talks about, and it might be the simplest of the 5. Before I go any further, let me be clear about something. I'm not selling you anything today. No book, no course, no seminar with a free lunch attached. I'm a retiree, and everything I'm about to share is what I wish somebody had sat me down and told me the year I turned 65, instead of me stumbling onto it 2 or 3 years late. Everything here is grounded in real Canadian federal and provincial rules and current numbers as of 2026, where a number can change from year to year, and a lot of these do, because they're indexed to inflation. I'll flag that so you know to double-check it when you file. Let's start with the CRA, the Canada Revenue Agency, the federal body that handles your income tax. Danger number 1 lives right there in your tax return, and it's called the age amount. This is a federal tax credit that becomes available the year you turn 65, and for the 2026 tax year, it's worth up to a little over $9,000 as a credit amount, not a refund of $9,000, but an amount that reduces the tax you owe. Here's the catch: it's income tested. Right now, it starts to shrink once your net income passes somewhere around $45,000, and by the time your net income reaches roughly $105,000, it disappears completely. Those 2 thresholds move a little every year with inflation, so the exact cutoff for whichever year you're filing is worth confirming, but the shape of it stays the same: modest and middle income. You likely get some or all of it. Higher income, it phases out. It sits on line 30100 of your federal return, and most provinces have their own version of it on your provincial return too, with their own separate thresholds. If you use tax software, it usually calculates this for you automatically, but I've talked to more than one senior who filed on paper for decades and simply never claimed it because nobody flagged it. If that's you, or someone in your life, it's worth going back and checking, and yes, you generally can ask the CRA to reassess prior years if you missed a credit. The second one hiding in your CRA return is the medical expense tax credit. Here's how it works. You total up your eligible medical expenses for any 12-month period that ends in the tax year, not just January to December, any 12-month window you choose, and then you subtract a threshold. That threshold is whichever is lower, 3% of your net income, or a fixed dollar amount that's indexed each year and sits somewhere in the high 2000s for 2026. Whatever's left over above that threshold generates a 15% federal credit, plus an additional provincial credit on top. The reason this matters so much for people over 65 is simple. This is usually the decade where dental work, hearing aids, mobility devices, prescription costs, and private caregiving start adding up, and a lot of those expenses qualify. One practical tip that trips people up: if you have a spouse, it's almost always better for the lower income spouse to claim the family's medical expenses, because a lower income means a lower 3% threshold, which means more of your expenses clear the bar and generate a credit. The third thing sitting quietly with the CRA isn't a credit you're missing, it's a deadline you don't want to miss. If you have an RRSP, a registered retirement savings plan, the government requires you to convert it into a RRIF, a registered retirement income fund, or an annuity by December 31st of the year you turn 71. You can't just leave it as an RRSP forever. Once it becomes a RRIF, you're required to withdraw a minimum amount every year starting the following year, and that minimum grows as a percentage of your account as you age. This isn't optional, and missing the conversion deadline can trigger serious tax consequences. There's also a related number worth knowing if you receive old age security. For 2026, if your net income goes above roughly $95,000, the government starts clawing back part of your OAS payment. None of this is meant to alarm you. It's meant to put it on your radar early enough that you and your tax preparer or a Canada.ca resource like the CRA's Tax Guide for Seniors can plan around it rather than get surprised by it. My honest advice on all 3 of these CRA items: when you sit down to file, or when you're working with a preparer, specifically ask them to walk through the age amount line, the medical expense line, and your RRSP to RRIF timeline. Don't assume it's automatic. Danger number 2 is your bank. Every one of the big Canadian banks, RBC, TD, Scotiabank, BMO, CIBC, and National Bank, charges a monthly account fee on most of their everyday checking accounts, and depending on the account, that can run anywhere from a few dollars to $15 or $20 a month. Over a year, that adds up to real money for something a lot of us don't even think about anymore because it just gets deducted automatically. Here's what most people don't know. Almost every one of those banks has a senior banking package, or at minimum a senior discount that either waives the fee entirely or knocks a meaningful chunk off it. TD, BMO, and Scotiabank generally start their senior discounts at age 60. RBC and CIBC generally wait until 65. But here's the thing, in my experience, and from what I've read from other people my age, tellers do not proactively offer this. You have to ask for it by name. Walk into a branch or call and ask specifically, do I qualify for a senior fee waiver or a senior discount on this account? Sometimes it's an automatic account switch. Sometimes you have to formally opt in, and the terminology differs by bank, so don't be shy about asking twice if the first person doesn't seem sure. While we're talking about the bank, it's worth understanding CDIC, the Canada Deposit Insurance Corporation. This is a federal crown corporation, and it's the Canadian equivalent of what Americans call the FDIC. If a CDIC member bank were ever to fail, CDIC protects your eligible deposits up to $100,000. But here's the part that surprises a lot of people. That $100,000 limit applies separately to each category of account. Your everyday savings is one category, a joint account is another, your RRSP is another, your RRIF is another, your TFSA is another. So a retired couple with money spread across a checking account, a joint account, and a couple of registered accounts at the same bank can genuinely have well over $100,000 fully protected without doing anything unusual. You just want to understand the categories so you're not accidentally over-concentrated in just one of them. If you ever have significant savings sitting in a non-registered account at one institution, that's the one to watch, because it only gets that single $100,000 bucket. Danger number 3 is your municipal property tax office. And this is where things get province-specific, so I'll give you the shape of it and encourage you to look up the specifics where you live. Ontario, British Columbia, and Alberta each run some version of a senior property tax relief or deferral program, and the details genuinely differ, so don't assume what applies in one province applies in another. In Ontario, there's a refundable credit for senior homeowners that gets applied for right on your tax return through a specific schedule. It's income tested, and the amount depends on your income, so check the current maximum when you file. In British Columbia, there's a long-standing property tax deferment program that lets eligible seniors defer some or all of their annual property tax as a low-interest loan against their home, though it's worth knowing the interest rules on that program change for the 2026 tax year onward. So if you're considering it, check the current rate before you enroll. In Alberta, there's a seniors property tax deferral program that works similarly. It lets you defer the municipal portion of your taxes through a low-interest loan secured against your home equity, and you generally need to be 65 or older with a meaningful amount of equity already built up. On top of all of that, plenty of individual municipalities run their own small grants or rebates on top of the provincial programs, and those are almost never advertised at the counter. The pattern across every one of these programs is the same. They are opt-in, they are application-based, and most of them have an annual deadline. Nothing happens automatically. My advice here is simple. Search your province senior property tax deferral, or your province senior property tax grant, or just call your municipal tax office directly and ask what's available to someone your age. So here's the pattern once you step back and look at all three of these together. The CRA, the bank, and the property tax office are not hiding anything maliciously, but none of them has much incentive to proactively tell you what you're owed or what you no longer owe. It's not their job to chase you down with good news. It's on us to ask the right question at the right counter. And once you start freeing up that money, a few hundred here from the age amount, a fee waiver there, a property tax deferral or grant somewhere else, a natural question comes up. How much should you really be keeping sitting in a regular checking account earning next to nothing? That brings me to the 5 solutions, and I want to walk through each one honestly, including the trade-offs, because nothing here is free money. It's about matching the right tool to the right job. The first is a high-interest savings account, or HISA, at an online bank like EQ Bank, Tangerine, or similar. These pay considerably more interest than a traditional big bank savings account. Right now, depending on promotions, HISA rates in Canada range broadly, so it's worth comparing current rates rather than assuming last year's number still applies. The trade-off is minor. You generally can't walk into a branch, so this suits money you want liquid and growing, but don't need face-to-face service for. The second is Government of Canada Treasury Bills, or T-bills. These are short-term federal government debt, considered about as safe as an investment gets in Canada, and unlike in the United States, there's no direct retail website like Treasury Direct where you buy them yourself. In Canada, you typically purchase T-bills through a brokerage or an investment dealer, including the discount brokerage arm of your own bank. The trade-off is a bit more paperwork to set up than a savings account, but the safety is very high. The third is GICs, Guaranteed Investment Certificates, which are the Canadian cousin of what Americans call a CD, a certificate of deposit. You lock your money in for a set term, anywhere from 30 days to 5 years, and you get a guaranteed rate in return. Right now, rates on GICs vary quite a bit by term and by institution, with online banks and credit unions often beating the big banks noticeably, so it pays to shop around rather than just accepting whatever your regular bank offers. A smart approach many retirees use is called laddering, splitting your money across GICs with staggered terms, so some of it is always coming due and available, rather than locking everything up for 5 years at once. And remember what we talked about with CDIC. If you're holding a large GIC balance, spreading it across a couple of different CDIC member institutions, sometimes called brokered GICs, can keep more of it fully insured. The trade-off with any GIC is liquidity. Your money is genuinely locked up for the term, with penalties or no early access at all in many cases. The fourth solution is where I want to be extra honest with you because the landscape has actually shifted. In the United States, retirees often talk about I-bonds as an inflation-protected savings tool. Canada's closest equivalent was something called real return bonds, or RRBs, federal government bonds where both the interest and the principal adjust with inflation. Here's the important update. The federal government stopped issuing new real return bonds back in late 2022. They didn't disappear. Older RRBs and RRB-focused funds still trade and can still be bought through a brokerage, including exchange-traded funds that hold a basket of them, but it's no longer a program the government is actively growing, and the supply is limited, which affects how easily you can buy and sell them. If inflation protection matters to you, this is worth a conversation with an advisor about whether an RRB-based fund still fits, given that limited and shrinking supply. And the fifth solution is a money market mutual fund held inside a brokerage or investment account. These funds pool your money with other investors' money and put it into very short-term, high-quality debt, things like T-bills and short-term corporate paper, and they're managed to keep the value of each unit stable while still paying you a return that tracks closely with current interest rates. The advantage is that your money stays quite liquid, often accessible within a day or two, while still earning noticeably more than it would sitting in a regular checking account. The trade-off, and this is important, is that money market funds are not CDIC insured the way a savings account or GIC is. You're relying on the quality and stability of the underlying fund, which is generally very high, but it isn't a government guarantee. So let's bring this all together. 3 quiet dangers: an unclaimed CRA credit, a bank fee nobody waived for you, a property tax program that requires you to raise your hand, and 5 honest places to put the money you free up, each with its own balance of safety, return, and access to your cash. None of this is about chasing risk or finding some secret investment. It's about closing the small, silent drains that quietly take money away from people in this stage of life simply because the system depends on you not asking. If this helped you see something you'd missed, do me a favor and send it to someone you know who just turned 60 or 65 or who's helping a parent through this exact stage of life. It might be worth more to them than they realize.